Good morning, guys, and this is Paul Messina, and welcome back to your Monday Mortgage Minute, your weekly market update for buyers, sellers, agents, and anybody else that's just interested in what's happening in the housing markets. Quick note before we jump in, I missed last week's update, and I appreciate everybody's patience. A lot has changed on my end. I have officially transitioned and launched the new Great Falls branch of Canopy Mortgage. Big move, big week, and now that the dust is settled, I'm excited to keep these updates coming consistently. Just to be clear, it's not a sales pitch. Just the shift gives me access to more competitive pricing, better flexibility, more control over the systems and processes to better serve you, my friends and clients. So now let's get into this week's data. BigNewsRealtor.com reported 1.07 million homes for sale in November. It's a bit lower than October, but that's still 13% higher than this time last year. A steady improvement in supply, even though we're still about 6% below pre-pandemic levels. Homes are taking slightly longer to sell, 61 to 64 days on the national average. Here in Montana, we're about the same, depending on your market, 45 to 60 days. And the median home price slipped about 0.4, that's 0.4% to 415,000 nationwide. So that tiny dip does not mean values are falling. Case-Shiller and ICE both show that home prices are up about 1% year over year. On the job front, and this is what really influences mortgage rates, ADP reported private sector job losses to be 32,000 in November. Economists expected a gain, so this is a meaningful signal that the labor markets will use to show that things are cooling off. Over the past 4 months now, we've seen a net loss of private sector jobs about 17,000, and unemployment claims remain elevated. Hiring plans are slowing down. In simple terms, the economy is softening, which typically pushes mortgage rates down to help stimulate growth, but also promote stability. Inflation continues to ease as well. The Fed's preferred measure is the core PCE, or personal consumption expenditure. That dropped from 2.9 to 2.8%. Small movement, but we're headed in the right direction. All of this lands right as we head into Wednesday's Federal Reserve meeting. Markets expect the Fed to cut short-term rates, but the real driver will be their message. If the Fed sounds confident about inflation, improving rates may drift lower. If the Fed sounds cautious, we could see rates bounce back up the way that we did after their meeting a few months ago, when there were a few dissenters in the ranks about whether or not they should go ahead and push for another rate cut. So on the technical side, mortgage bonds are stuck between two support levels, and the 10-year Treasury is testing a key ceiling. When markets box in like this, any major news can break that pattern very fast. Your takeaway: we have softening job markets, easing inflation, and a major decision in the next 48 hours. Rate volatility is highly likely. If you're buying, selling, or refinancing, this is a strategic moment to get with your lender, review your plan, and consider locking your rate before the Fed moves the markets. If you want help modeling these scenarios, understanding how these shifts may impact you or your clients, I'm here to support you. Just let me know, reach out to me. Be sure to click that subscribe button and get our alerts, and we'll see you next week for your Monday Mortgage Minute. Hope everybody has a great week.